All right. This is a video on how to write off business SUVs, vans, and trucks. My name is Christopher Carmona. I'm a CPA and a CFE. Let's get right to it. This is for businesses who buy gross weight vehicles that qualify for 100% deduction under bonus depreciation. Those vehicles are SUV, vans, and trucks. This is not for passenger vehicles. So the Tax Cut Jobs Act basically changed the definition of buying new equipment to include also used equipment. And that equipment can be written off in year one. It includes purchases for items put into business between 9/27/17 and 12/31/26. This usually is meant for big, heavy equipment. You buy a $250,000 machine, you can write it all off in year one. And typically these machines have repairs and maintenance that go along with that. Well, it also includes heavy SUVs, vans, and trucks. What we're going to do today is decide whether you should write it off in year one or not. It's a big selling point. Car dealers, used salesmen or used car salesmen and so forth, try to sell you this type of tax advice. And what I want to do here is kind of clarify whether you should do it or not. It's usually best used in a tax year where we have abnormally high profits. So let's say that you, for some reason, you usually take in 100 grand a year and you took in $250,000. You want to buy two $90,000 SUVs to drop that income down and write it off in the first year. That could be an option. And we're going to discuss the pros and cons of doing something like that. We also want to look at what the vehicle is going to be worth at the time the depreciation period is over. So if you're buying it and you choose not to write it off in year one, you usually depreciate it over a 5-year period. It could be straight line depreciation, Maker's 200% depreciation, which is what I used in my example at the end of this video. But that's just an expense that's also allowed. If you sold the vehicle at the end of this depreciation period or at the end of year two, you got to recapture all that depreciation that you took. So let's recapture means you're basically paying a capital gains tax on the sale. So let's look at actual cost versus standard mileage. And this is really the crux of how you're going to determine whether the vehicle you bought should be depreciated over the period or whether you just take the IRS standard mileage. You have to make the choice in the first year of purchase when you're choosing standard mileage. So if you're going to choose actual costs, it's good in a year if the first year of the mileage just wasn't as high as expected, or if you had a ton of vehicle maintenance. It was a used car, yeah, it was a used truck, but you had to put in a new engine, a new transmission, so on and so forth. And in year 5 or so, when you're done depreciating it, it's not going to be really worth that much money. You're going to probably have to get a new one. The vehicle life is just not what you think it's, or is not going to last forever. Because remember, we're looking at a 5-year timeline under standard depreciation rules. So if actual costs are chosen in the first year, if you want to write off, hey, I bought it for 90 grand, this awesome, amazing Range Rover that I'm using for my, business, then that's fine. But you're not going to be able to go then next year and say, hey, I chose I drove 20,000 miles. Why can't I write off my $11,000 in mileage? And you can't. You're done. That 90,000 is a one-time shot. So let's go into why this is so critical. You can see the problem here becomes if you choose actual costs and you write off the entire vehicle, then you can never use that standard mileage in the future. So if your business has high business mileage in the years after your depreciation has been used up, you're not going to get any benefit for that. And I'm going to go into that in the example below because I think the numbers are going to work better than me just explaining it to you. So let's go ahead and jump into that. Before we do, I want to look at some considerations first. Is the vehicle under warranty? So if it's not, repair costs can be significant. Fuel costs. How much is gas expected to go up? Is it a gas guzzler? Insurance and registration costs. Depreciation costs, if you're not going to write off 100%, let's say it's, I used a $50,000 car below under 200, but let's say you did straight line, that's $10,000 a year that you're writing off for 5 years. After that, you get nothing. Expected annual mileage driven, 58 cents a mile on the IRS website for 2019. And then don't forget your business percentage. If you're only using the truck half the time for business, you're only getting half of these costs. You get half of the fuel, half of the registration, so on and so forth. If you're using it 100%, obviously you get 100. All right, so in this first example, you bought the car for $50,000 at the end of, or beginning of June, so end of May. Under the depreciation rules, we're going to use 200 to kind of balance. There's a formula for it, but essentially this is what you're taking every year, and it's going to add up to $50,000. Let's put some estimates in there. Let's say you spend $2,000 a year in gas, except for that first year because we only did a half a year. Insurance, $3,500 every year. Repairs, probably not so high because it's brand new. So the actual cost you spent on your vehicle, year one, $13,000, year two, $21,000, $15,000, and so forth. This is 6 years, but it's really 5 because we did a half year here and a half year here. So 5 years out, boom, you spent $85,000 on this car. That's what you're writing off against your tax return. Now, let's look at your mileage. Say you're a realtor or an agent, someone who drives a lot, 15,000, or a contractor, 15,000 mileage in year one, 30,000 a year. It's not unusual for a heavy truck, an SUV, someone with a ton of clients, salespeople. You're allowed 58 cents a mile. So in year one, you get $8,700. You can see in year one, if you go with a mileage, you're going to lose, right? $5,000, you're out. Year two, you're still losing $3,000. Year three, you're making about $2,000. Year four, year five, and so forth, you're reclaiming all of your money back if you choose the standard mileage deduction. So let's look at it at the end of just this 5-year holding period. You have $85,000 in actual costs and $95,000 in standard mileage. So you make more, you save more in taxes if you went with the standard mileage. Under this scenario, I suggest that you create your own Excel sheet and put in your realistic figures and see where you end up. And you don't have to use my system to do this. You can just do just divide it by 5, 10,000 a year, and prorate for the months so that you can do a good calculation. You can always ask your CPA or give me a call. But this is essentially a good example of how a purchase price of $50,000 may not be worth expensing all in year one. Over time, it may be worthwhile to let it go. Now, remember, this is for $50,000. Let's say it was those Porsche Cayennes, something that's going to be worth essentially $5,000 at the end of 5 years. Right? It's an expensive, big ticket car, not worth much at the end, uses a lot of fuel, and you don't drive it that much. Well, then, because you're going to get rid of it in year 5. Well, in that scenario, maybe you do want to go with actual costs. This is a conversation you're really going to have with you, your partners, or your financial advisors, or your CPA, because it's going to be up to you and your preferences. Some people like to upgrade cars every 5 years. Some people like to use them for 10. The next example, I'm going to just go 1 year out. It's going to say you keep this car for 6 business years. So in 6 business years, the only thing I did here was in year 6, I added $2,000 in maintenance fees. But you can see there's no more depreciation that you're allowed to take. You took it all. You took all $50,000. So your actual costs are only $6,000 in that year 6. But you're still driving 30,000 miles a year, taking clients around. So you can see tremendous savings here. It's $11,000 in just this year. So if you used it for 6 years, your tax savings went up to $20,000. And you can imagine 7 years, 30, 8 years, 40, 9 years. Now that you're moving it out, you're having a ton of savings because you're not allowed this depreciation anymore because you took it either all in year 1, which you're allowed to do under the Trump Tax Cut Jobs Act, or you spread it out over 5 years using an acceptable depreciation method. Either way, nothing can be done after that year. So you really have to look at your actual costs, how much mileage you're driving, and do a comparison between those two and how far out you plan on intend to keep the vehicle. I hope this video helps you. If you have any questions, you can always give me a call or shoot me an email, and we'll be happy to get in touch with you. Thanks for watching.